Hello, Anthony.
Hello, Claudine.
We're back talking about IPUs, International Practice Units. It's a job aid and training material for IRS employees. Basically tells them how to audit people.
Right. It's not even a unit. Like, not a unit. It's a unit of knowledge. Right.
International Practice
Right.
Unit.
But it's not an actual, hey, I'm going to assign you to this unit over there. It's a learning unit.
Now, this one is about the determination of US shareholder and CFC status. Important to know if you are, because if you are CFC status, then there's a lot of forms you should be filling out. If you don't fill out these forms, there are some pretty steep penalties.
The determination of CFC status is basically it's the essence of international tax planning and international tax problems. If you are CFC, then the Subpart F, that terrible taxing regime, kicks in, and also the forms that are required to be filed. So if you could avoid that CFC, oh yes, you are in great shape. And there are ways. So we're going to talk about that in a little bit.
There's a couple little loopholes. Now, what's interesting about these IPUs is they are right on the IRS's website. They're public knowledge, information. They can be a little tedious to read through all the facts, but I think it's really cool for practitioners like us because now we know what they're looking for.
They are telegraphing what they are going to be auditing about. And it is interesting that here they have a whole bunch of IPUs, and people just sort of ignore them. And I think it's easy. Well, I don't know if ignoring is a word. There's so much to them. It's just better to ignore them, Mike, because as soon as you start scratching a little bit, you go deeper and deeper and deeper. Then you realize a lot of these international planning things you were looking to do aren't necessarily going to work. And even if they do work, there is a cost that's going to be associated with the compliance. There's really a lot of risk. So when people are looking to do something offshore, we usually our sort of default position is like, are you sure you want to? Because maybe we could find something domestically.
Used to be a good idea.
Yeah.
Okay.
Well, right.
Now, I thought this was interesting. So the opening, right on the opening of all the instructions, it says, you are auditing a taxpayer who's been linked to a foreign entity.
It's a crime. It's a crime.
Perhaps, and I just think this is so vague, perhaps during an interview, the taxpayer is asked whether they own any stocks in a foreign entity, and they say yes. Or you notice deposits wired from a foreign company during your review of the taxpayer's bank statements. What audit steps should you take? And why is it important? So yeah, it's like, it just seems so like, well, you were talking to the guy and maybe he mentioned something. Can we have a little more concrete?
And yeah, this is where, so many times when we are advising people on whether or not they should go into the OVDP program or the Streamline program, whatever it is, and they say, well, nothing's in my name. It's in a friend of my friend's name, my brother's name back in the home country. And it's like, okay, that's fine. So what you're going to tell me, though, is if we look at your bank deposits, we're not going to see an inbound wire from some strange thing a few times. We're not going to see an outbound wire. Is that what you're seeing? Because I'll tell you what they're looking for, because they know most things aren't in people's names. Because a lot of foreign banks, you can't have it in your name. It has to be in the name of an entity. So this is really what they're looking. What they're really looking for is these foreign entities, because here, you get everything with this audit, right? You get your penalties on the missing forms. The tax treatment's really nasty, and then you might even be able to get those F-bar penalties, which really throw it out to significantly high penalties.
Can you sum up why having a foreign corporation is, they say major tax advantage of using a foreign corporation is income tax deferral?
Yeah, well, I would say that's an interesting way for them to, of all people saying that, the IRS saying that, because, and I think as we explain it, you'll see why it doesn't really work like that. But it used to be, many, many years ago, it used to be there, there was loopholes that you could drive whatever you wanted. You could drive the Queen Mary 1 drive. You wouldn't drive that. You would steer it. There we go. All right. And really what you do is you just take your money that you have in the U.S., you ship it off to whatever other country, let the money just accumulate there tax-free, and you would only pay taxes on it when you repatriate it to the U.S.
Okay.
And what's the problem with that? Because basically all it sounds like is a 401k that you're doing. So what's the problem with that? Well, the problem is the IRS wants their money. And so they created a lot of these, they really tightened up these loopholes with Subpart F, with these foreign reporting requirements, so that deferral part isn't so easy to do, because you can still do it. And I think, the one way to do it is just don't be a CFC.
Right.
Then a lot of things can work.
Now, they have specific step-by-step instructions for the auditor on how to determine if you're a CFC. Yeah. If more than 50% of its voting power or value is owned by US shareholders. So not 50% or more, 50%. No, we talked about this.
it's 50. It's more than 50%.
More than 50%.
Right. And I think it's also important to say the voting power too. And it's important that they have that, because there would be a nice little thing you could do. But they kind of have you at there too.
Yeah.
So you just got to keep that, 50% or less works.
Next, we have to determine, is the taxpayer a U.S. shareholder?
Yes.
Yes, if they own 10% or more of the total voting power of that foreign corporation. So we thought of a couple different ways where maybe you could avoid that.
Yeah, and I think this is what is confusing, because it actually is into the benefit of the U.S. person, because this is what's confusing about it, because you think everything is going to be bad news, and it's actually, no, this is kind of good news. You only count as a U.S. shareholder if you have 10% or more.
So have 9%.
So have 9%, but if there's somebody who is triggering you over 50%, oh, well, it's a CFC. That
Or over 10%.
So if anyone's triggering it over 50.
Oh, okay,
right,
gotcha.
Then it happens. So, one of the quickest ways, the easiest way is like, well, if you had 100 U.S. persons, 100% U.S. persons, 100 U.S. persons owning 1%, is that a CFC?
Nope.
No, even though it's 100% controlled by U.S. persons, it's not a CFC. So so now Subpart F doesn't kick in. So fantastic. Maybe we could take care of some deferral. So now you could have 10 people. And what would that be?
Well, 11 people would all have 9.09%.
Right.
But they can't be related in terms of...
How do the table of consanguinity? That was what was in trust in the States when you try to figure out how your relation was.
So it can't be a mother, father, child.
Mother, father, right. So, but brother, sister.
Okay.
And there is going to be a legal term to describe it. I don't know it. It's been a long time.
Aunts and uncles. So if you could get 11 people together.
Yep.
There you go.
Who are related, but not by... They can be somewhat related, but not through direct lineage.
Now, you had mentioned if
right.
perhaps, let's say it's some family friends. If two people happen to really like each other and end up getting married,
now you got a problem.
Now
right.
you've got a problem because
Right.
it does trigger.
Right.
If that goes over 10%.
It may trigger it. So you got to watch it. That's really the problem with these, is that when you're sort of going and trying to set this up, is, well, you got to, who's going to inherit the stock? Someone dies. Who's going to get it? So you got to keep it separate. So maybe going for the minimum isn't the greatest idea. And also they will look through the control too. So if you're setting up structures to say, well, I'll have my corporation and I'll open up 10 different corporations that will all own it. They'll actually go through that and to find the U.S. person behind that. So we got to be careful of that. So you actually want to have it split up by people.
Right. Now, the last instance we thought of, even less people. So you
Yeah.
have one person that has 50%.
Right.
And you split the remaining 50% with 6 people. They each own 8.33% of the corporation.
Right. And that's, we have come up with 7 people is the minimum required to avoid a CFC status. That's what, and if someone has a different math on that, I'd love to see it, because every time we've gone and tried to adjust this, it triggers it. So that's the lowest, so 7. Of course, you're really, dangling on an edge, because, right, if any interest does transfer to one other person, you might have a problem. So that is a way to do it. These are... and it doesn't seem like a lot of people take advantage of this, because this is, there's a reason why the IRS doesn't mind this rule so much, I would say. Because how is it that in the minimum, in this case, 7 people who aren't married to each other, aren't the sons or the parents of somebody, would have this sort of relationship? I guess my uncle through marriage had 8 brothers, 2 sisters. But they don't have anything offshore. That's what it would take to do that. And then, there might have been fights between them too. That's
that
the other thing
tricky.
too. Even with a large family, and all it would take is 2 people to beef. And so I think there's a reason why the IRS doesn't mind this rule, because it's really hard to meet this requirement again and again on every yearly basis. And the idea that somebody might trigger that CFC now goes back, and now they have someone in the trap. All these years you didn't think you were required to do that,
Even if they're not family. Let's just say you have a relationship with business partners. Those can go bad as well.
Right.
And I wanted to quickly mention a foreign insurance company is a little bit different. Their 25% or more is owned by 10% U.S. shareholders. So they have a separate rule.
Oh, all right.
Yeah. So next, the auditor, it says so they are indeed a U.S. shareholder of a CFC. There's then a list of other IPUs to investigate. They make sure that they note which one have monetary penalties associated with them. So basically they're saying, go make sure they filed 5471. Make sure they filed 926. Did they check the box? So a list of probably about, 15 different IPUs here.
That's right.
That now you can go and investigate this taxpayer to see what you can find on them.
Right, and because there's these huge penalties. So this is where we're saying, don't you see, if you're going offshore, you got to make sure there's really going to be a good benefit for you, because I'll tell you, your legal fees on this, in order to make yourself compliant, are going to be substantial. You better have a significant tax savings year after year after year if you want to do this, or just have a legitimate reason. And again, your Subpart F is only for passive income. So if it's an active corporation, it doesn't really count.
Right.
So that's really, so if it's a real company doing something, then we're not going to worry so much about CFC, except if this is one little trick that the IRS does look for. If your foreign corporation is sitting on a lot of cash and forgets to use it for operations, they could trigger, well, that's actually a passive foreign investment company. So that's one thing they like to, they look for, is that trigger.
Yep. Now, my favorite part of the IPU is, let's say you don't meet the criteria. You're not off the hook. They're like, hey, auditor, even though they're not, they might, since you saw this, maybe this wire or this something else, here's a list of like 5 or 6 other IPUs that you can check just to make sure they don't owe us any penalties.
Well, and this is what they do. Because, as we go through these audits with the IRS, is the auditors are seeing this. And so they see one foreign thing. One foreign thing. What they're going to do is send an information document request, an IDR, and it's basically everything. Every form foreign. If this applies, if this applies, if this applies. So your choices are to either lie, not a good idea, or sort of go through it, and there might be some penalties that you're on the hook for, because they all have it now. Where before these IPUs, auditors really didn't know a lot of the foreign stuff.
Right.
It really wasn't available for them, and now they're kind of copying and pasting whatever it is. Oh, send us all your 3520s. Send us all of this, and it's really, and it can be really confusing. And most of this stuff, I could see the auditor might not know exactly what they're looking for, because well, you should know that that won't apply.
Yeah.
They're just throwing out a very wide net.
Yes. And, my theory is the auditor has already put in a lot of time to investigate you. So even if you're not CFC, they're going to try to find something.
Well, I would say it's like this, Claudine, that the IRS has put a lot of effort into these IPUs. And so if the auditor doesn't see something, they're going to be, and something comes up, they're going to get hammered a bit to say, hey, look, we just went over to say this is our priority, is finding these international taxes, finding these international penalties, and you ignored it. So that's really what they have to be really vigilant. And sort of over-vigilant would be a way I would describe it when it comes to international.
Yep. So what we're going to do is we will continue our IPU videos. We want to do touch on 8865, Subpart F, check the box. So if you have any questions, you need any assistance with international or domestic tax issues, don't hesitate to contact us. You can subscribe to the channel so you're going to get updates every time we do one of these new videos. You can contact us, info@irsmedic.com. You can also call us, 888-727-8796, and check us out at irsmedic.com. Thanks so much for watching. IRSMedic, the law offices of Parent & Parent, LLP. Real tax attorneys for tough tax problems.